Hi everyone, a very good evening and welcome to yet another session on our Edelweiss Classroom, Connect Classroom sessions. Before I start, I genuinely hope that you had an excellent and fulfilling time with your families during the festival season, right? And the topic that we have chosen today is uh, is is called 8 common mistakes made by mutual fund investors. The idea, very honestly, for conducting this topic and talking to you on this today is to make us all cognizant of these very, very common mistakes, so that while we are on our investment journey, uh, these such common mistakes are something which, if you best ask me, are best avoidable, and through this we aim to exhibit these mistakes or talk to you about these mistakes so that we don't I mean so that we either stop making these mistakes if we are already making them, or in during the course of our investment journey we don't make these mistakes at all. So on that note, I'm sure all of us who are here are investing our hard-earned money into various investment asset classes, right? I mean that's something which is completely your choice. I mean, you must be investing your I mean, we all invest, right? But what is also true is that very few of us are perhaps able to generate and create wealth, or create that extra alpha from our investments. And this predominantly, the reasons for us not being able to do that is because somewhere or the other we are making some or the other mistake in our investment journey. So what I'm going to do is we are going to delve into what could be one of these, some of these mistakes, 8 of these mistakes, to be very to be very honest and count them, uh, and somewhere, why we should stop them. And on that note, let's talk about the first mistake. And the first mistake that perhaps a lot of us have done in our investment journey is withdrawing our investments before before the money is there for us to achieve any tangible goal. We need to have an investment goal. We need to invest with a purpose. We need to think about why are we investing, what are we going to do with this money when when we generate that amount, you know and that should become something where we put in a lot of thought. We put in some amount of thoughts of why are we investing. If we don't, you know uh, we would never know how much do we need and when. And then, how it usually happens is we invest, over a period of time. In all probabilities, our investments does generate a certain amount of wealth, or does generate certain amount of returns. And then, some of the other requirement at that time pops up. So what we do, we remove that investment and use it. I mean, I'm not saying there's anything wrong in that, but what happens is then there is that constant struggle which we are into, as to how am I going to cross over that next step. If I really want to make my money create something for me which I require in the future, then I need to think about what is that purpose, and that's my goal. Please, please, please think about an investment goal. If you don't, very honestly, it's like, you know uh, we are out traveling, but we don't have a destination. We are playing football, but there is no goal post. We are running a marathon, we are running a race, but there is no finish line in sight. We may enjoy the journey, we may enjoy the process, but it just doesn't have that you know tone of finality, which is in my opinion, so important. And that goal in investments, that investment, that, what am I going to use this money for, is that tone of finality in my investment journey. I mean, I'm investing, I'm making money, I'm using it as and when I want it. It all seems fine. But, if I want to have that sense of comfort in my mind that I am creating something, this is how I'm going to use it, then that gives me a higher sense of achievement. That gives me a higher sense of control, which I think we all strive for. So have some goal or the other with every investment of yours. The goal is of your choice. That's something which is totally up to you. But do think about how are you going to use your money. The second mistake that we all make is we become impatient when markets turn choppy. We need to remember volatility is something which is not in our control, especially when it comes to equity and equity related instruments or equity markets. It is here to stay. And individually, or even, a few of us together cannot do anything about it. The only thing that we can do is we can absorb this volatility, which we need to do. And it is not even a choice. If I'm investing in equity or equity related instruments, my money will be exposed to a degree of volatility during the investment journey. And I will have no choice but to absorb this volatility. We cannot panic. We need to control our emotions and stay the course. We need to somewhere develop our own individual capacity to withstand this volatility. Because in the long run, if I am able to actually do that, this could help me generate, in all probabilities, returns. Mind you, I'm not saying that, we should not track our investments. We should invest and forget. I'm not saying that we should not delve into what the performance is and, how this performance, why is this performance not as per your expectation. And you should ask all of these questions. There's absolutely nothing that I'm telling you to stop doing that. But volatility is something which is not in our control. Like I said before also, we need to accept this as a part of our investment journey and absorb it. There is absolutely no second thoughts around it. The third mistake that we all perhaps are making is thinking of savings as investments as being the same thing. Many of us have a certain amount in our bank account, and somewhere mentally we also start calculating that as our investments. It isn't. Not saying that we should not keep our money in bank accounts. Please, whatever your comfort amount is, we all like to see some comfort and we like to see that, money available to us. I'm not saying that you should not keep it there, completely, don't get me wrong over there. But that is not an investments. Investments in today's times is, when I am putting my money to work and this money is generating returns for me, which is very honestly at least higher than current inflation levels. Investing in wealth creating instruments is not only important but a necessity for most of us. And hence the idea of investments should be that, we are investing in, these higher than inflation products, and I'm able to beat this inflation comfortably through my investments. Because very honestly, if I'm not able to do that, then generally what I would conclude with this is my money is not helping me create any wealth or any surplus for me in the future. Forget even wealth, surplus. Very honestly, my money is not growing. It is going on the negative side, because if inflation is higher than my returns, then technically I am not making money, I am losing money. And the sooner I realize the difference between savings and investments, and keeping whatever I want as my safety net in my bank account. That's all right. I'm not saying you should not do that, but utilizing all of the rest of my money to generate and create inflation beating returns over the long term by choosing to invest into instruments which are giving me inflation beating returns is something which is essential and a very important element of investing, and we must all do that. That's the third mistake. The fourth mistake that we all perhaps are making is we are trying to time the markets, and this is something which I can tell you at some level or the other we all have been guilty of. Markets are down, it will correct, I'm waiting for that right optimal level to invest. Markets are moving up sometimes, and I start thinking that this is the peak, I want to remove at this level. There is this thing where most of us have tried timing the markets, and it's true for a lot of people. We read information, somewhere, we start reading markets are bottoming out, markets are moving down. I mean, and then, we read about experts talking that there is a little more correction that they're expecting, and I also start thinking that, this is what I want to do. I want to, wait for that bottoming out. We very honestly, not even the best of the investment experts are able to time the markets. And it's a fact. Okay. So timing the markets is perhaps one of the most futile exercises that most of us have indulged in. Instead, very honestly, what I should be doing is not worry about timing the market, but, spending time in the market. And how will I do that? I will do that by focusing on investing at regular intervals, staying invested for the long term, especially if my investments are in the equity markets, and letting my money grow over this long period. Not worry about, timing the markets, not worry about, this is the bottom, this is the peak. We've seen enough evidence in the past that whatever has been a bottom in the past, that's never come back. We've also seen enough evidence that whatever has been a previous peak has been broken and a new peak has been achieved. So, looking at markets and looking at, that I'm going to time this is something which I can tell you, with my conversations with a lot of people, a lot of investment experts, is perhaps the most futile thing that people have indulged in. And the sooner we let go of this and stop worrying about timing the markets and start thinking about our time in the markets, and the longer we spend, especially when it comes to equity and equity related instruments, I mean, we've seen enough evidential data that if I spend a long time, the probability of me being, generating positive returns from my investments is much higher. So that's what we should be focusing on. Don't time the markets. Try to spend as much time in the markets as possible. That's the fourth mistake. The fifth mistake that we've all probably done is, or some of us have done, is investing in too many schemes. When I'm talking about too many schemes, I'm talking about too many similar schemes. This is a problem which we call as the problem of over diversification. I have a lot of similar schemes. So when it comes to equity, I have a lot of large cap schemes. I have a lot of mid cap schemes. Now they all may probably having a portfolio. When I'm talking mutual fund, a lot of mutual funds, there'll be an overlap in portfolios also, right? And hence, this is not helping my cause. In fact, it may be difficult for me to track how much money is where, or what is the returns getting generated. And, there are too many things which I have to keep track of, in order, because now I have over diversified. So although there is no ideal number, but it is, but as an option, if I were to put, I would say invest in 5-7 schemes which are well managed and keep adding to this investment only. See, to select a scheme, there is a lot of hard work that you get into, right? I mean, you look at a lot of data, you talk to people, you talk to maybe your distributing partner, you look at your own research, the partner's research, whatever way you're comfortable. And basis that you come to a conclusion that I want to invest in scheme A or scheme B or scheme C, and then you keep on repeating this exercise. If you've done the hard work, you're convinced that this is a good scheme, then why not add into these schemes itself? So investing in too many similar schemes may not actually help your purpose. It is going to, in fact, make it more difficult to track, to consolidate. So build a portfolio which is diversified, which has schemes across, different market capitalizations, has a diversified portfolio. But having similar schemes may not really help. So this is the fifth mistake, investing in too many schemes. The sixth mistake is actually, the exact opposite of this. A lot of us have a very, very lean portfolio. We don't diversify. We look at one or two schemes. We think this is the best scheme. We want to put everything here. One or two stocks also, people think that this is what this is what I want to invest in. I've done my research. Now this is a problem where I am not diversified at all. So very clearly, the element of risk over here goes up. Because if this scheme doesn't perform, or there is something, or this stock that you're investing into doesn't perform, then your entire investment may be at risk. So clearly what you're doing by not diversifying your portfolio is you are exposing your investments to a higher degree of investment risk. You need to diversify across asset classes, have equity, have fixed income, maybe have some gold, if we were to look at some common investments, paper investments, at the same time, create a portfolio which is spread even further. So if you're talking of equity, choose schemes across market capitalizations, so that if there are opportunities, in which different market capitalizations work, you still have a positive alpha that you're creating. Create a diversified portfolio. If you don't diversify, you are unnecessarily exposing your investments to a higher degree of risk. You should look at minimizing your risk and maximizing returns from your investments in your portfolio. Another common mistake that we all perhaps make is we try to imitate other successful investor strategies. Right. Today, there's a lot of information that is available. We read a lot, especially when it comes to investments. Also, a lot of us read, we go through a lot of literature. We look at, how successful investors are investing, what's their strategy, and there is a lot of books, lot of material over on the internet also, which is available, which we spend time in investing. But I can tell you, the situations will be different. So it is not necessary that the same strategy will work. The situations will be different. The environment will be different. The timing that in which they are talking about will be different. There are a lot of things which will be different. So very honestly, two investors investing at the same time, it is not necessary also that they may have a similar investment experience. So what I should do is, I'm not saying we should not read, we should not understand, we should not look at how successful people are doing things. Yes, we must do that, but we should learn from them. Imitation over here will not, add anything extra to my portfolio. So we don't have to imitate. We can learn. So, okay, these are situations in which this person did like this. Okay, it's interesting. If I come across a situation like this, I'll check if the same thing can be replicated. If not, I will look at what best I can do. We learn from others. That's perfectly fine. Like over here also, I'm talking about these mistakes. I may have made some of them myself. It's not necessary that I have made all of these mistakes. At the same time, you may have also made some mistakes. So over here, when we look at this, oh yes, this is one thing which I did, I learned. But this is something which I didn't do. But that doesn't mean I should not learn that. It's not necessary for me always to make the same mistake, right? I mean, now that I'm going through this, it is possible that I absorb something from here and I ensure that I don't make the same mistake. So don't imitate, learn from others. So this is the seventh mistake, so imitation doesn't always work, because the situations are different market conditions, different market times, and hence imitation is not something which we should imitate, which we should follow. We should learn, that these are situations. In these situations, something like this was done. Can this be done, or what should we do? We can learn from that situation. That's what we should do. The last mistake that we should all stop doing is keeping unrealistic expectations from our investments. And there's also something I think a lot of us would have indulged in. We keep reading, right? I mean, and we keep reading that this particular market cap is delivering this return, or we read about this scheme has delivered this return in this time frame, and that becomes the flavor of the season at that point in time, flavor of investing at that point in time. And we think that we should invest in this scheme. Nothing wrong, right? I mean, fundamentally, the scheme, works for you. The risk appetite of yours and the risk element in the scheme is something which seems, synchronous. So there's nothing wrong. I'm not saying we should not look at what are those schemes which are doing well, but expecting that similar return or similar alpha, extra alpha will get created during your investment journey also is very honestly very, very unrealistic. It's something which may not happen. So the idea should be you invest in schemes, you have an expectation basis whatever data you're looking at, but it needs to also be realistic. Focus on your expectations, and invest in those investment options which are exhibiting some track record to deliver on your expectations. Don't have unrealistic expectations. Okay, this scheme has done exceedingly well in the last 3 years, so I'm investing now. Will I have a similar experience? Very honestly, the frank answer is no. Because I mean, if there is something because of which it's done exceedingly well, I'm not saying that it may not continue doing well, but will you have a similar experience? In all probability, no. So you should have expectations which are more realistic. Think about what are your expectations. What is your expectations from a scheme? How is this scheme stacking up against that expectation? And basis that, invest in schemes to create your long-term financial wealth. So these are those 8 mistakes which we all, which a lot of people have made. And my idea, like I said, was to take you through these 8 mistakes, so that either we have made some of these, some like me would have made a lot of these, but we learn, right? And if you've not made any mistakes, I hope that this session helps you. If you've not made some of these mistakes, I hope this session helps you to become cognizant of those mistakes. And we should always remember that we don't need to withdraw our investments before we hit our targeted goal. So we need to think of a purpose for investment, think of a goal, and stay invested through the journey to ensure that I reach that goal. We need to be patient with our investments. Generating returns is not something which can happen overnight. For a lot of us, it takes time. We need to be patient. We need to differentiate between our savings and investments. Savings is not equal to investments. We don't need to try and time the markets. It's a futile exercise. Most of us have failed, and there is no reason for us to do that. We don't need to invest in too many schemes. But at the same time, we need to diversify our portfolio across asset classes. So having too many similar schemes will not probably add, add anything great to my portfolio, but not diversifying will also be very, very detrimental and negative to my portfolio. We should learn from others, not imitate their investment strategies. And lastly, we should not have any unrealistic expectations from our investments. So these are those 8 things which we should remember. We should try to imbibe and remember during our investment journey. This is what I had. I mean, I'll take your questions now, and whatever questions and queries that you have, you can put it in the chat. I'll be more than happy and willing to respond to those. There's a question, should we go for longer periods always? So when you're talking about equity or equity related instruments, then yes, I mean, short term, the markets may be volatile and that may not help you in your investment journey. But there are a lot of short-term investment options also which are available through mutual fund schemes across fixed income predominantly, which you could look at if you have money for short term, and you could talk to your financial advisor, mutual fund distributor, or whoever you're investing through to know about these schemes. So there are options available for short term also, but equity and equity related instruments, the idea should be that you stay invested for the long term. If you have any questions, once again, I'll request you to post it in the chat box, and it will reach me and I'll respond to them. Okay, I guess we had just one question, and okay, there is something. Okay, there's a question. Where do I see Indian markets in the next 7 to 8 years from now? I see this market's better than higher up from today, to be very honest. Is there a number which I can predict? Then no, I can't. No point in timing the market. Like I said, spending time in the market is something which will help us all make money. So over the next 7 to 8 years, if I'm invested, I'm very positive that I'll make money. So there's a question which says expectation of every person may vary, and absolutely correct. Expectations will be different for every person, and that is why I said individually I need to first decipher what my expectations from my investment are, and basis that choose an investment. Absolutely. I mean, you and I will not have the same expectations from our investments, and that is absolutely correct. But I will have certain expectations, and I should invest in schemes which meet that expectations. Similarly, you should invest in those schemes which meet your expectations. So there's a question, are star ratings of MF schemes a good way to decide on MF schemes? Sure. I mean, if there is a rating agency which has worked and basis that, given some rating, I mean, a lot of people look at it. I'll not say whether I subscribe to it or no, but it is a way in which people look at. So, if you want to look at it from that side, it's your choice. So there's a question, should diversification be done in different types of funds like small, mid, multi, and large, or any two types of funds are okay? So you should diversify across different market capitalizations when it comes to equity, but diversification, very honestly, is a much larger thing. So you should not only look at equity, you should look at some other asset classes also, in order to ensure that you have a well diversified portfolio created. So yes, but in equity, you should look at various market caps at least. So you should have something in large cap, mid cap, small cap at least to start with, I would say. So how long is long enough? I mean, that's something which is very personal. For how long am I going to stay invested depends on my goal, and basis that I will decide on what is my investment, asset class choice. Anyone else? Any other queries, questions? Okay, so great. As usual, thank you for joining. You've been a great audience, and we hope to connect again in the coming months with some more interesting topics with you. Thank you very much once again. See you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.